This isn't a rally anymore. This is a delivery audit, and the market is trying to pretend it's just another green candle. Because when you see a number like 3,812 contracts demanding settlement now, the story isn't gold up, gold down. It's who's blinking. And more importantly, what part of the plumbing is starting to squeal. And if you stay with me through the end, I'm going to give you the one spread, the two price zones, and the next week checklist that tells you whether this turns into a controlled retest or a continuation squeeze where the premium shows up before the chart does. Let's translate the headline into something that can't hide behind commentary. One standard COMEX gold futures contract is 100 troy ounces. So 3,912 contracts is 391,200 ounces of gold. That's a little over 12 metric tons. Not a meme, not a vibe, not a Twitter thread, a real chunk of metal if it is actually being stood for rather than rolled into the next month. And that distinction, stood for versus rolled, is the first trap most people fall into, because the futures market is designed to let you express price exposure without needing to touch metal, while delivery is the part of the system that forces everyone to reveal whether they were trading price or financing inventory. Now, before anyone starts yelling default or rigged, tighten your framing. A delivery surge doesn't automatically mean a system break. It means stress, it means incentives change, it means the easiest trade, short paper against someone else's patience, gets harder because someone just told the market, no, I don't want to roll, I want settlement. And that's where the real pressure starts. Here's the part people miss. The first signal of delivery stress isn't the spot quote flashing on your screen. The first signal is almost always in the relationship between months, the front end of the curve, the calendar spreads, the EFP dynamics, the little gaps that appear when metal has to move instead of just trade. Because price can be managed in the sense that a thick liquid futures market can absorb flow and keep the tape looking orderly. But spreads don't lie the same way, because spreads are where inventory and time get priced. And when time gets expensive, the market is telling you something is tightening, and it's happening right now for a reason. Calendar matters, this week matters. Early year positioning and thin liquidity can be a lethal combination. You've got desks resetting risk, funds rebalancing, dealers marking new option exposures, and the market still digesting whatever macro narrative it thinks it believes. Meanwhile, the delivery window doesn't care about anyone's story. It's mechanical, it's procedural. And when those procedures collide with a thin order book, you don't get smooth price discovery, you get air pockets, gaps, spikes. That is why this kind of episode can look calm right up until it doesn't tee. And the next detail is what flips the whole setup. So how does delivery pressure actually work in practice? Think of it like a choreography between two roles, the side that issues and the side that most stops. The issuer is effectively the short that delivers. The stopper is the long that takes delivery. Most of the time, many participants don't want either role in physical terms. They want exposure, so they roll before it becomes a real-world obligation. But when a long refuses to roll and stands, someone on the short side has to meet that obligation, either by delivering metal, sourcing it, or using the mechanisms that convert one form of exposure into another form of settlement. The key is this. Even if the exchange can facilitate delivery smoothly, the act of standing changes dealer behavior. It changes how much inventory they want to hold. It changes their hedge ratios. It changes their willingness to make tight spreads. And that change shows up in the microstructure before it shows up in the headlines. Now let's talk about the conflict, why people are motivated to downplay delivery demand. Because when you admit delivery stress, you admit that the paper market is not the whole market. You admit there's a boundary where financial exposure meets physical constraint. And that boundary is uncomfortable for institutions that profit from providing liquidity under normal conditions. Dealers want orderly settlement because disorder means volatility, and volatility means risk limits, and risk limits mean they widen spreads or step away. Funds want calm because calm makes leverage look intelligent. Media wants a simple story because simple stories sell. So the first response to delivery pressure is usually narrative control. Nothing to see here. This happens every month. It's just bookkeeping. Sometimes that's true, sometimes it's not. The market doesn't care which one you prefer, but that's not the part that matters. The part that matters is whether the stress is isolated to a single report or whether it's echoed across independent signals. That's how you stay finance credible without becoming conspiracy poisoned. You don't need certainty. You need a stack of proofs that all point in the same direction. Mechanism, then symptom, then behavior, then the structural tell. And when those line up, you don't have to scream. You just have to be early. So here is the hidden detail that reframes the whole story. Delivery demand becomes dangerous when it tightens the nearby spreads enough that carry stops being cheap. Carry is the cost of holding metal over time. Financing plus storage minus any convenience yield. In normal contango, future months trade a bit higher than the front month. reflecting the cost to carry. That's healthy. That's normal. But when the front month becomes relatively expensive, or when the spread tightens hard, it's a sign that immediate availability is being valued more than time. In other words, the market is pricing urgency, and urgency is how premiums are born. Because premium isn't a feeling. Premium is a wedge. It asks what shows up when the cheapest form of gold exposure is not the same thing as the form of gold someone actually needs. Futures are standardized. Deliverable bars are standardized. Retail products are a completely different animal. Fabrication, logistics, dealer inventory, and the simple fact that small pieces of metal can be conjured out of thin air on a Monday morning because a chart looks bullish. And if you've ever watched a tight market, you know the weirdness starts small. Delivery times stretch, quotes become subject to confirmation, spreads widen. The shop that was happily selling at a modest markup suddenly doesn't have any, or they have it, but not at yesterday's price. That's when the paper crowd argues about spot, while the physical crowd quietly pays up to get the thing in their hand. And that's where the real pressure starts. Now, a $150 premium claim sounds dramatic, so let's ground it in mechanics instead of hype. A $150 premium does not require a mythical collapse. It doesn't even require a formal failure. It requires a bottleneck at the wrong point in the chain while demand is pulling forward. That's it. If futures are elevated and volatility is high, dealers protect themselves by widening retail premiums because their replacement cost is uncertain. If fabrication is constrained, premiums rise because the product is scarce, not the metal. If shipping or refining lead times extend, premiums rise because time becomes a cost. If investors suddenly prefer immediate possession over financial exposure, premiums rise because convenience yield becomes real. That's not magic, that's supply chain math. And if the delivery demand is actually real and concentrated, it can amplify this. Because when a meaningful number of contracts stands, the market has to answer a simple question. Where is the deliverable metal coming from at the margin? Not in total, not the world has lots of gold. At the margin, in the category that can settle, in the timing window that matters, in the bar type that qualifies, in the location where it's needed. That last part is what flips the whole setup. Because inventory numbers, when people do talk about them, get treated like a single bucket. Stocks are up, stocks are down. But the warehouse system often has categories that matter differently. Metal that is eligible, metal that is registered, metal that is deliverable, versus metal that is simply present. And even when metal can be converted from one category to another, that conversion isn't free. It requires someone to volunteer. Someone has to sign the paperwork and accept the terms and the economics. When stress rises, fewer people volunteer without a price concession. That's how a premium expresses itself. It's the concession needed to coax metal into the channel that settles obligations. Not because the earth ran out of gold overnight, because incentives changed. Now, let's connect this to right now price context without getting lost in trivia. As of the latest close, gold futures are trading in the mid-4,000s, with the front months hovering around the mid-4,400s to mid-4,500s. That's not a sleepy market. That's a market where every $50 move has leverage implications for somebody. It's a market where a normal pullback can trigger margin calls and a normal breakout can trigger forced buying. And that's why delivery pressure, if it's happening, matters more than the exact number. It changes who is forced to act. Because here's how short covering works in the real world. A short is fine as long as they can finance it and roll it. The moment the roll becomes expensive, meaning the spread moves against them, or the moment someone stands and demands settlement, the short loses flexibility. They can still manage it, but it gets pricier. If price rises at the same time, their margin requirement rises too. So they face a double squeeze. Higher mark-to-market losses and higher cost of maintaining the position structure. That's how a positioning story becomes a mechanical buying story. And that's where the market stops caring about opinions. Now layer options on top, because this is where it can turn vertical. Dealers who sell options are not sitting there praying. They hedge. If call open interest is heavy near key strikes and price starts pushing through those strikes, dealers may need to buy futures to stay hedged. That buying can itself push price higher, which forces more hedging, which pushes price higher again. That's gamma reflexivity. It's not a theory. It's a feedback loop. And when liquidity is thin and volatility is already elevated, the loop doesn't take days. It can take hours. But that's not the part that matters. The part that matters is identifying the line where the market can't unsee it. There are typically a few key zones that flip behavior. In this tape, you can think in simple steps. First, the area around the previous settlement zone in the mid-4400s. Call it the gravity band, where price keeps checking whether buyers are real or just chasing. Second, the psychological $4,500 handle, because round numbers are where options. Positioning often clusters and where headlines get written. Third, The upper band in the low to mid 4,500s where the market starts behaving differently because it's either breaking into new air or failing and dumping hard. If the market holds above that gravity band and keeps closing strong, it's not just bullish, it's structurally supported. If it loses that band and can't reclaim it quickly, that's when the controlled pullback scenario becomes likely. Because if this one level breaks, the math changes. So let's build the proof stack the right way. Not one argument. 5. First proof, term structure behavior. You don't need to be a spreads wizard. You just need to watch whether the nearby spreads tighten or invert relative to what you'd expect from normal carry. If the front end keeps getting bid, the market is saying immediate metal is being valued. That supports the delivery stress thesis. Second proof, delivery participation patterns. In many markets, you'll see the same large participants show up repeatedly as stoppers or issuers. If delivery demand is surging, the question isn't only how many, it's who. Concentration matters because a few large entities can represent deliberate inventory accumulation rather than retail noise. When the fingerprints repeat, it signals intention, not coincidence. Third proof, inventory category shifts. Not total stocks, but the categories tied to deliverability and willingness to settle. If the metal that can settle obligations is trending tighter, or if it's being replenished only reluctantly, that's a sign of stress. Fourth proof, cross-market friction. Watch the relationship between New York pricing and other hubs. Arbitrage is powerful, but it's not magic. If there are persistent frictions, persistent premiums in one place, persistent tightness in another, it suggests logistics and bar-type constraints, not just speculative flow. And those frictions can persist long enough to create visible premiums. Fifth proof, on-the-ground symptoms. This is the one the chart-only crowd hates because it's messy, in dealer quotes, delivery times, availability, the stuff that doesn't come in a neat candlestick. When the system is loose, physical supply is boring. When it's tight, physical supply becomes a story. If you start hearing, we have it, but that but is the premium forming. Now, let's address the skeptic case cleanly because credibility comes from arguing against yourself better than your critics can. Skeptics will say, delivery can be internal reshuffling. Eligible can be converted to registered. Large inventories exist globally. Premium spikes can reflect fabrication bottlenecks, not metal scarcity. All fair. And that's exactly why we focus on the hidden detail. Spreads, timing, and incentives. If the spreads are calm, if the roll is cheap, if inventory categories are stable, and if physical availability is normal, then the scary narrative is just content. That's the invalidation. That's the line in the sand. And if that's what the data shows, you adjust. Because in real finance, being wrong is normal. Staying wrong is the sin. But if spreads are tight, if delivery participation looks concentrated, if inventory categories show strain, and if retail availability tightens at the same time, then you're not dealing with a single headline. You're dealing with a system that's pricing urgency. And urgency is where premiums can jump. Now, let's talk specifically about the $150 premium again, because I want you to understand how it can be inevitable in a conditional, mechanism-driven sense without being reckless. A retail premium is not the same thing as a futures premium. Retail premiums can spike even when futures are stable, because retail is about product, not just metal. If the market senses stress, dealers widen. If volatility rises, dealers widen more. If replacement supply is uncertain, dealers widen again. If buyers rush, dealers ration with price. That is the uncomfortable truth. Price is how the market says, not everyone gets it right now. If futures are in the mid-4,000s, a $150 premium on certain products is only a few percent. In tight conditions, a few percent is not exotic. It's a normal expression of risk and scarcity at the product level. The next detail is what flips the whole setup. Because the real driver isn't just demand, it's demand timing. If people pull demand forward, meaning they buy now instead of later, then even a stable annual supply can feel tight. That's reflexivity. Rising prices increase demand urgency. Urgency tightens availability. Tightness increases premiums. Premiums validate the tightness narrative. And the cycle feeds itself. Not forever, not smoothly, but long enough to produce the kind of chaotic tape that shakes out impatient participants. And that's where viewer psychology becomes part of the story. Here's your psychology shield, and I'm going to say it bluntly. The market will try to emotionally farm you with volatility, even if your thesis is correct. You'll get a spike that makes you feel late. Then you'll get a dump that makes you feel stupid. Then you'll get a rip that makes you feel regret. That cycle is not accidental. It's how liquidity is harvested. Weak hands provide the inventory that strong hands accumulate. The trick is to separate trend signal from noise. Trend signal is what price does around key levels on closing timeframes. What spreads do when the market is stressed, what positioning forces dealers to do, and what physical availability looks like. Noise is intraday violence, headline whiplash, and the emotional need to be right immediately. If you can name the difference, you stop being tradable. So let's map the next week or two with a two-scenario lens, because this keeps you honest and it keeps you safe. Scenario 1 is the controlled pullback and retest. In this scenario, price dips into that gravity band in the mid 4400s, shakes out late longs, maybe tags a lower support zone, and then attempts to reclaim. The confirmation is not it bounced. The confirmation is that the bounce holds, spreads stay firm, and the market closes back above key pivots with volume that looks like accumulation rather than panic covering. In this scenario, premiums can still rise because volatility remains high and dealers remain cautious, but the tape gives you windows, breathing room. Scenario 2 is the continuation squeeze. In this scenario, price holds above the $4,500 area and pushes into new highs, and the options market forces dealer hedging to chase. The risk here is gap risk, moves that happen when you're not looking, when liquidity is thin, when stops are clustered, when the market jumps levels instead of trading through them. In this scenario, premiums can spike quickly because fear of missing availability becomes as powerful as fear of missing upside. And in this scenario, the emotional trap is chasing with size because the chart looks easy. It's never easy. The market just makes it feel easy right before it punishes you. Now, what confirms the delivery stress thesis, specifically over the next week? Watch 3 things that don't care about opinions. First, does the front end of the curve stay tight? If time is being priced as urgent, you'll see it there. If the curve relaxes, the stress narrative weakens. Second, do the delivery patterns remain elevated or concentrated? If the stand for delivery behavior fades, the system may have absorbed the shock. If it persists, the market will have to keep paying to coax metal into settlement channels. Third, do physical symptoms show up? Not sensational ones, practical ones. Wider retail premiums, longer lead times, rationing behavior, more call for quote. Those aren't perfect data, but they're human-level signals that the chain is tightening. What weakens or invalidates it? If spreads normalize, if delivery intensity drops, if inventory categories remain comfortably supplied, and if physical availability remains boring, then the inevitable premium claim becomes just a headline. In that case, you shift your focus back to macro drivers and technical structure, rather than plumbing stress. Because if this one level breaks, the math changes, both in price and in narrative. Now, let's briefly anchor the macro backdrop, because even if you ignore delivery, the macro tape still interacts with gold through rates, currency, and risk perception. Gold cares about real yields and liquidity conditions, because it competes with cash returns. Gold cares about currency stress because it's a global asset with no single sovereign liability. Gold cares about geopolitics because it's a hedge people reach for when trust gets expensive. And gold cares about institutional flows, funds, ETFs, central banks, because large, steady buyers change the demand floor. You don't have to worship any one story. You just have to see that multiple roads can lead to the same trade. A bid for monetary metal when confidence in other assets is being repriced. But that's not the part that matters. The part that matters is what participants are forced to do this week. Dealers are forced to hedge. Shorts are forced to manage roll and margin. Funds are forced to mark risk. Physical buyers are forced to decide whether they want exposure or possession. And when those forced choices line up, you get the kind of move that makes people say, "This is different." Sometimes it really is. Sometimes it just feels like it. The way you tell is by watching the plumbing. So here's your concrete roadmap, and I want it to feel like a dashboard in your head, not a prediction tattooed on your ego. Watch the $4,500 zone as a behavior line. Above it, the market tends to attract momentum. Options dynamics can amplify, and dips can get bought faster than you expect. Below it, the market can still be bullish, but it becomes more vulnerable to stop runs and deeper retests. Watch the mid-4400s gravity band as the "do we have real support" test. If the market keeps defending it on closes, the structure is strong. If it loses it and can't reclaim, the tape can turn nasty quickly, and the best entries often appear only after the market flushes emotion. Watch the upper $4,500 area as the air pocket zone. If price pushes through with force, you can get a fast extension where chasing becomes expensive. And watch for weekend gap risk and thin liquidity moments, because those are when the market chooses violence. And while you do that, keep one rule close. Size follows clarity, not excitement. If your thesis is delivery stress, your evidence is spreads, settlement behavior, and physical symptoms, not a 1-minute candle. If your thesis is macro bid, your evidence is rates, currency, and risk tone, not a single headline. When you keep the evidence matched to the thesis, you stop being whipped around by noise. Now, let's bring it back to the headline number 1 last time, because I want you to use it properly. 3,912 contracts is not a prophecy, it's a probe. It's the market being tested. If those contracts truly represent immediate settlement demand rather than routine rolling behavior, the system can handle it, but it will charge for it. It will charge through tighter spreads, wider premiums, and more violent price action. That is why a premium can feel inevitable, in the sense that risk has to be priced somewhere. If it's not in the futures quote, it's in the spread. If it's not in the spread, it's in the physical premium. If it's not there, it's in availability. The bill always gets paid. The next detail is what flips the whole setup. So what do you do with this as a retail investor or a macro watcher who doesn't want to get played? You watch the plumbing. You name your scenario. You define your invalidation. You respect volatility. You don't let a green candle bully you into chasing, and you don't let a red candle shame you into panic. You build a repeatable process, because the people who win in markets aren't the loudest. They're the calmest when the tape is trying to hypnotize everyone else. And if you are the kind of person who rather understand the mechanism than argue about the headline, you're in the right corner of the internet. Stick around this community, because we don't do hopium, we do structure. Next week, watch the spreads, watch the closes around that $4,500 behavior line, and watch the physical symptoms that show up before the chart tells the story. If the stress is real, you'll see it there first. And if it isn't, you'll know early enough to stay flexible. That's the edge. That's how you keep your capital and your sanity in the same room.